Hi everyone, let's have a look at my medium time frame, low time frame and micro preferred and alternative bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the medium time frame bearish scenario, which might be my preferred scenario, where we're looking for a WXY with inside the final wave Y a 3-wave structure in a zigzag, which is then a 5-wave move in the A 3-wave move in a B, and then eventually expecting another wave C to the downside. In this particular scenario, we have the yellow target box down here, which is sitting between 24,850 and 24.3k. And for me, that is quite an important target. However, an A, B, and then a wave C have a relationship with each other. Usually, wave C is around the same distance in price compared to wave A. And if you want the most common target area for wave C to be around the yellow target box, which is the 1-to-1 to the 1.236, taken then from the high of A to the low of A to the potential high of a wave B, this wave B has to go all the way to the 786 to get this result. Currently, it's right on top of the swing failure pattern type move and the golden pocket at 28.3k. But if I then move it to the upside, you can see that while I move the potential B high to the upside to the 786, the 1.236 is still in confluence with the yellow target box. So basically the whole area between the golden pocket and the 786, which also includes then the blue target box that we have over here, which sits between 28.9k and 29.2k, is an interesting area of interest for then a potential short scenario for this B, shorting it then to the downside for an impulsive wave C, where then again the yellow target box can be an interest for a reversal to the upside, so a potential long trade. Of course, you need your own plan, your own strategy, and if price is moving to the upside, we want to see some proof of resistance, right? Maybe a market structure change, bearish divergences, whatever it is that you have in your strategy to enter a trade. If we then go to the alternative bullish scenario, it's an alternative for two reasons as written over here. Now, first of all, this scenario is an A, B, C. So basically a zigzag structure. It's already finished. It hit the most common target area for wave C, being the 1 to the 1.236. Taken from the high of A to the low of A to then the high of this wave B, with a rare target being the 1.618. And for this potential long trade that we had when price wicked over here, it was an entry at the 1-to-1, stop loss below the 1.618, as that is kind of the invalidation for a scenario. You don't want to see wave C going below this level, to be honest, which is, by the way, sitting at 23.7k, for then a move to the upside where we expect higher prices, right? Because this is the end of the downtrend that we have over here. But for two reasons, this is actually three maybe, a alternative scenario. First of all, the wick over here did not have any target box. So I do like my target boxes because those are areas of confluence and often act as very nice resistance or very nice support. But over here with this wick, yes, I did have one single thing for a support resistance area, in this case a support area, which was over here. So here we had some resistance and I had a horizontal line which then acted as support, but only having that one support resistance flip for potentially a trend reversal, I don't know, I don't necessarily like that. I prefer my target boxes to be hit. And also this wave C over here is shorter than wave A in time. So what you see on the chart, the two vertical lines are fib timelines taken from the high of A to the low of A to then the high of wave B. And then you're comparing wave C in time to wave A in time. And as you can see, the 1-to-1 of wave A is over here, sitting at the 16th of May. But this wave C would then already be finished in a 5-wave move over here on the Friday, the 12th of May. So it's a shorter, around the 0.618 fib time wave C compared to a wave A, and usually, most commonly, a wave C is a little bit longer. So that is something to take into account. Besides, and that we will talk about this in a second, the lower time frame counts are suggesting a potential move to the downside still. If we then move to the CVD divergences, I surely still want to show these divergences. They played out, so I'm going to remove it from my chart as well. But we had bearish divergences where the main target was the low over here, which has been taken. We had a bearish divergence over here from this high to a lower high on price, higher high on CVD, which means downwards pressure and absorption. And then also more locally between this high and the highs over here. So again, a lower high on price, but also more locally higher high on the CVD, where that target, the small one, was at 27.1k and the bigger target was then 26.5k. And if I open the CVD chart for you over here, you can actually see it. Let's go to the 1 hour for the bigger CVD. So over here you then had a lower high in price, but on the yellow line we had a higher CVD. And more locally, going to the 15-minute for the downwards pressure over here, the little one, we had again, let's zoom in a little bit more, a lower high on price, but a higher high on both the blue and the yellow CVD. And the blue CVD is the Bybit CVD, the yellow line is the Bybit CVD, and the blue line is an aggregated CVD from many platforms. And both work. You can find the template and everything in my Discord. So this already played out. Trading CVD divergences, I got this question in Discord, so I think it's interesting to trade or to talk about it, that if you see divergences, of course, they don't play out 100%. No indicator I know in the world plays out 100%. It's just another way of, or another tool you could potentially add to your toolbox if it fits your personal developed trading strategy, right? But in this scenario, the invalidation is always the high. So if we have a high and then a lower high, but on the price and the CVD has a higher high, then the stop loss is always above the high. And the first target is always going to be the low that is made in between the two highs. Now, if you have a scenario where basically it's turned around, and actually that happened over here. So we had a higher low in price, but a lower low on the CVD, then the entry is going to be here, stop loss down here, and the first target is going to be this high. So that being said, I hope that is a little bit of interesting educational content for you. Now I will remove this from my chart because it already played out. Then we go to this bullish divergence. So we have the low over here, higher low on price, but a lower low on the aggregated blue line CVD. So there's many different CVDs. I just happen to use these ones because they fit my strategy. And we have a lower, actually you can see it as we look at the chart over here. We have this being the low, higher low in price, lower low on the blue CVD. So there is some bullish divergences. However, I also noticed this morning that with this push to the upside, you can see the yellow line is much higher in CVD compared to the highs that we have over here. So that is at least something to take into account when looking at these bullish CVDs, right? But then the potential, again, example for a potential setup is entering over here, and then the main target is, or the first target is going to be 27.6k, which is then the high between the two CVD lows, okay? So if we then go to the low time frame scenarios that I have for you, I have 3 low time frame scenarios. One is then of course preferred, and I have then eventually 1 micro left. The alternative scenario over here is the very bullish scenario, where this structure is a wave 1. It is honestly very difficult to count a nice 5-wave impulsive structure in this wave 1, which is the main reason why this is an alternative scenario, followed then by a wave A, expanding flat B, and another wave C to the downside, which then is a zigzag structure, and one could potentially put wave B over here or here, it doesn't really matter, for then eventually a wave C, ending at the golden pocket, which is the most common target area for a wave 2, and also hitting around like the daily naked point of control. And now you would expect an impulsive structure to the upside for then a third wave, in this then being a wave A, a wave 1, wave 2, and then a bigger wave 3 to the upside. That if this is going to be a wave 3, what you want to see is you want to see volume increasing when price is going to push to the upside, right? Because a wave 3, in this potentially being another 1, 2, and then another 3 to the upside. So a wave 3 over wave 3, you really want to see volume increasing, and then you might know you're in a wave 3. But at the moment, this is an alternative scenario. Another alternative is the more bearish scenario, where this is already a finished ABC correction, and we're now in a wave 1, 2, and then another move to the downside, and then a bigger wave 3. Now this is a big alternative scenario because we do have the bullish divergences going against this scenario, and also if this is a wave 1, followed then by an expanding flat wave 2, first of all, a wave 2, most common wave 2 corrective pattern is a zigzag, which is a 5-3-5 wave move, but clearly that is not the case. This is an expanded flat structure. And then if this is another wave 1, then another wave 2, and this then being a wave 3, 4, 5, well, the problem is that then this potential wave 4 retraced too high to the upside, hitting the golden pocket, while a wave 4 should only close candles below the 0.5 on, at least on this time frame, below the 0.5 on the 15 minute. So I can show you if this is the high of 2, this is the low of 3. I drag it to the right side. You can see the golden pocket is hit, which is a very, very rare target for a wave 4. So yeah, this is not preferred. And another reason is that if this is a wave 1, this is a 2, and then another 1, 2. I prefer this second wave 1 to take the low of the first wave 1, which clearly is not the case. And then we go to my preferred scenario at the moment, which means we are still going to get upside, but this upside will eventually turn into more downside. So it is basically in confluence with the medium time frame bearish scenario that I've shown you. So in this scenario, we then have an ABC in a bigger wave W, followed by again an ABC in then a wave X. And then we expect another move to the upside, which then is another wave Y, 3-wave move. So another zigzag, which is then another wave A, B, C, which is a 5-3-5-wave move. Therefore, we then create a double zigzag. A double zigzag is basically a 5-3-5 in the W, any corrective structure in a wave X, and then another 5-3-5 in a wave Y. Now, this is important. If we are not going to get a 5-3-5-wave move, but instead we're going to see a big impulsive move, then we might go to the bullish scenario, right? Where this is going to be a wave 3 to the upside. So the difference is between this being a wave 3 or potentially a wave Y is a wave 3 is going to be a very vertical structure to the upside with a high amount of volume, while a wave Y is going to be more of a sideways structure. Usually you can also put a range on a wave Y, where then the high of wave Y is going to be at the high of that range. So that is a little nugget for you guys as well. And the volume should be lower than in a wave 3. So of course, volume might increase when price is going to the upside, but it should never be as much as it is with an impulsive, more vertical structure to the upside in a wave 3. Now, this wave X hit the most common target area that we were looking for, including the daily naked point of control. Very, very nice indeed for then a expectation to the upside. It is important to say volume and proof of support over here, because we had a big amount of volume to the downside, which you can see over here as well. So it is quite risky to enter a trade over here the moment this red candle closed, right? But instead, one can also play it more safe and wait for some proof of support, which might be a market structure change, after which you then enter, might be waiting for a retracement and then some bullish divergences, whatever it is that fits your plan. In this particular scenario, we then look for the target of wave Y to be between the 1 and the 1.236, taken from the low to the high of W to then the low of this wave X. And this target area is between 28.2K and 28.7K, which also includes the highs over here for potentially a liquidity grab and a move to the downside. But just above the 1.236, we also have that target box I spoke about in the medium time frame, which is between 28.9K and 29.2K, for an interesting area of support for then maybe a move to the downside. So at least in this scenario, we are expecting more upside, and then depending on the move that we get towards the upside, we can think about, hey, is this going to be a WXY? Or is this going to be a wave 1, 2, 3, right? That's the question. Now, if we then finally go to the very low time frames, the micro time frames, the 15-minute over here, then the move to the upside can be a potential impulsive structure in a wave 1. And that is actually thanks to John. When I woke up this morning, I always enjoy checking the Elliott Wave counts of John in the Discord group. You'll find him there. And he made this count over here from the low. So we're now looking at this structure over here, right? And he made this count. So a leading diagonal in wave 1, then you have a corrective wave 2 over here, followed then by a 5-wave structure in this wave 3, corrective 4, and then eventually another 5-wave move to the upside. So you can count an impulsive structure in this move to the upside. And of course, thanks to John for figuring that out. He is a very low time frame Elliott Wave counter. And then we have a corrective structure. In this wave 2, the most common target area for wave 2 is between the 0.5 and the 0.786 fib, taken from the low over here to the high of wave 1, which is between 26.7K and 26.5K. So I do expect wave 2 to go down a little bit further. Now, this can be a 3-wave structure like that. We do have a little bit of bullish divergences, but to be honest, I prefer to have bullish divergences with the low instead of like an in-between low, because this is the low of this whole structure, and this is not like, this is like what I call like an in-between low, right? So I prefer to have divergences, bullish ones, between the low over here and then the potential higher low of wave 2 instead of something like this. So that's something to take into account. And the target for these potential bullish divergences on the lower time frame is over here at about 26.9k. And if we then zoom in to these divergences, let's go to the 5-minute. Then what I mean over here is you have a higher low on price at the moment, but a lower low on the blue CVD line. Not on the yellow, but on the blue aggregated CVD, you can see that we have a lower low. So we do have some bullish divergences very locally, but it also has to be said that on the yellow line, we have bearish divergences. So it's a mix of both, and that's also why I don't necessarily like these bullish divergences, because on the yellow line, we have a lower high, right, on price on the 5-minute, lower high here on price, but clearly higher highs here on this CVD. So we have to wait and see how this is going to pan out. I mean, with the candle that is pushing right now, if we look at the CVD, it dropped massively over here throughout the last couple of 5-minute candles. So maybe the like the bearish divergence that we had can be invalidated on the yellow line, because with this high over here and the high on this CVD, now price is below and not above. So you could argue that the bearish divergence that we had over here is gone because of the CVD dumping over here in the last couple of 5-minute candles, which then leaves the bullish divergence. But hey, this is very low time frame trading. Again, I prefer price eventually moving to the downside, finding support somewhere over here around the common target areas for a wave 2, for then eventually another push to the upside. And these bullish divergences, well, I'll remove them from now. They're not really my favorite, but at least I wanted to show you. So the bullish scenario is this being a wave 1, then we have a wave 2, and then eventually a wave 3 to the upside for a big push. Or this can be a wave A, B, C. And if this is an A, B, C, well, for a wave 2, the 382 is a rare target. But for a wave B in an A, B, C, the 382 is a common target. So if we would bounce and go up, then more likely to be a wave B. But if we're going to find a bit more downside, which I prefer, it can be both a B and a wave 2. So we have to wait and see what happens. The bearish scenario is that you would count a 3-wave structure in this move to the upside instead of a 5-wave move. And then if this is a 3-wave structure, one can still expect this low to be taken once more. So we have to wait and see how that goes, right? So I hope this video was helpful or valuable to you. Please check out the macro and the high time frame video if you're interested. And for now, thanks for watching and subscribing, and I will see you at the next one. Bye bye.